My name is Kayla Taylor, and this is my informative speech on credit scores and what they mean for you. And this is my audience. How many of us here have ever heard the phrase the American dream? I would be willing to bet that everyone in this room has heard this phrase numerous times throughout their life. According to OxfordDictionaries.com, the American dream is the ideal that every U.S. citizen should have the equal opportunity to achieve success and prosperity through hard work, determination, and initiative. Now, what if I told you that even if you gave all you had and worked as hard as you could still find yourself denied of that dream, all because of a special number you may or may not know about? This number is your credit score. In 2014, StatisticBrain.com performed a study that revealed that 37% of American adults admitted they did not know their credit score. Most people knew that their score could determine whether or not they can buy a new car or a new home, but very few people actually knew that it could affect your life in many ways. Working at a financial institution has given me the opportunity to work closely with credit scores and help me to obtain useful knowledge. During our time together, I will attempt to educate everyone here on the importance of credit competence and give you the knowledge to set you on the right track to credit confidence. First, I will describe what a credit score is and what it is used for. Second, I will examine the factors that are used to determine your credit score. And lastly, I will discuss ways to help you improve your score and become more aware of financial wellness. A credit score is generally a number that is used to evaluate what kind of financial risk you may be. Having proper knowledge of what a credit score is the first step to learning just how important this number is. Equifax.com describes a basic definition of a credit score as a rating used by a lender to help determine whether or not you will qualify for a particular credit card, loan, or service. The credit reporting agencies apply an in-depth mathematical equation to the information in your credit file to yield your credit score. Most credit scores estimate a risk a company incurs by lending you money or providing you with a service, specifically the likelihood that you will repay your debts in the next 2 to 3 years. The higher the score, the less of risk you represent to a lender. Credit scores are calculated by credit bureaus. In the U.S., there are 3 credit bureaus: Experian, Equifax, and TransUnion. These bureaus collect your information to form a credit profile and then use their scoring models to analyze this information and come up with a score between 300 and 850. The information is usually similar across the bureaus, but that does not necessarily mean your score will be the same. MyFICO explains that as one bureau having unique information on you that another bureau may not, or it could have been calculated differently. How high or low your score is can determine many things. They are most commonly used to determine if you will be approved for a loan or credit card, but banks, insurance agencies, service providers, landlords, and even employers can all use your credit scores to establish they would like to establish a financial relationship with you. One common misconception is that a credit score will remain the same indefinitely. As I previously mentioned, credit bureaus obtain credit scores by using a scoring system to analyze a customer's credit profile. The exact way these scoring systems come up with your score is unknown because each lender can have their own system. One of the most popular scoring systems is FICO. FICO has been recognized as the U.S. standard scoring system and is the most popular with the credit bureaus. There are several factors that are taken into consideration. These factors include open credit card utilization, percent of on-time payment, number of derogatory remarks, average age of open credit lines, and total number of accounts, and total hard inquiries. Each factor holds different weight when it comes to calculations. For example, percent of on-time payments and number of derogatory remarks will have more of an impact on your score than, say, average age of credit lines and total inquiries. Knowing that there are so many factors that impact your score can be sort of intimidating. So I'd like to give you a few tips to help you stay on the upside of healthy credit. If at some point you find yourself unpleased with your score, you will then be happy to know that it can always be improved. The most important step in improving your score is always repaying your debts on time. If you always repay your debts on time, you will avoid having an account go into collections or bankruptcies. Another way to avoid a lower credit score is do not have unnecessary inquiries. Inquiries come from a lender pulling your credit for any reason at all, whether or not they establish a financial relationship with you. So to avoid this, to avoid having numerous ones on your report at one time, if you don't need it, don't try to get it. Another way to maintain good credit is to maintain a good credit utilization. This means having a healthy balance on your cards at all times. And lastly, the most important way to stay on top of credit is to always monitor your credit profile. Whenever you know what your credit score is at any given time, you will always be aware of any factors that will impact it, so that way you can take the necessary precautions to improve your score. With many credit scores being more and more involved in our daily lives, it's highly important that we know what they are and know how to deal with them. Today we have discussed what a credit score is, how they are used, and ways to improve them. I hope the next time you find yourself with a questionable situation regarding your credit, you will remember some of the information you have learned today and will be able to make an informed decision in the future. The end.